Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. We're coming to you live from the SALT conference in New York City. Joining me for this segment, we have Nadeem Meghji. He is the head of Blackstone Real Estate Americas. We're going to discuss why real estate is not all the same and where you invest certainly does matter. Nadeem, it's great to have you with us. Welcome to TradeTalks.
Jill, thanks for having me on.
You got it. Commercial real estate, of course, has been widely discussed at SALT. What are you seeing at Blackstone?
Yeah, the interesting thing about real estate today is that more than ever, you can't paint the asset class with a broad brush. And what I mean by that is that there's a huge bifurcation today between winners and losers, between asset classes. And I'll just give you one example. Take the industrial business, warehouses. That's our biggest exposure, 40% of our global business. And what we see on the ground is really record fundamentals. We see record low vacancy in the US, only 3%. We see rent growth that's in the double digits. And if you think about why that's happening, think about the way we shop. E-commerce penetration has grown, that drives demand for warehouses. Now add to that the onshoring of manufacturing and you have even more growth. To us, this sector is as healthy as it's been. But on the flip side, take the office business. US office represents less than 2% of our global business. And there are challenges in this space. Vacancy rates are north of 20%. Rents are under pressure, values are under pressure. Think about why that is. That's because of remote work, that's because of changes in technology, a pullback amongst tech companies. And so our job as investors is really to understand how people live, work, and play, demographics, technology, and then really double down on the sectors that are producing high growth.
And you launched a $30.4 billion fund that's the largest ever in real estate or private equity. Tell us more about that.
Yeah, look, we're really pleased to have had the final closing of our 10th Global Opportunistic Fund. And at $30 billion, it is the largest real estate fund ever raised, the largest private equity fund as well. And I think it's really a testament to the fact that we've delivered for our investors through cycles over 30 plus years. We've delivered a 16% net IRR on $100 billion of committed capital. And we think today's market is really opportune for us in terms of deployment because what we've always seen is that volatility creates opportunity, especially at a moment where debt capital and equity capital is more scarce.
Where do you see opportunities in commercial real estate? In other words, how are you going to deploy capital?
Look, we think we're going to continue to be thematic. And what I mean by that is if you look at our $600 billion global portfolio today, the vast majority, 83%, is in only 5 asset classes. It's in warehouses, which are driven by e-commerce. It's in rental housing, which is driven by a shortage of supply and a demographic shift to the Sun Belt, which is a place we've been very focused. It's in life science office, which is driven by biotech R&D. It's also in data centers, which are driven by historic growth in AI and in the cloud. And then finally, in hotels, which are really supported by growth in global travel. I think you'll find that we will continue to be very high conviction thematic investors in this next part of the cycle. But I would also tell you, we're not waiting for the all clear sign to start deploying. We've acquired or committed to acquire globally so far this year $4 billion of warehouse assets. We've also committed to several $billion of data center development opportunities. So we're deploying as we speak, and we think the pipeline will pick up in the coming quarters.
Are there opportunities in the public markets?
Yeah, look, we have a long history of public company transactions. We've done 50 of them since we started our business. We think we're uniquely positioned to do that because of our scale and our expertise. Having bought companies like Hilton in 2007, like Biomed Realty, the fastest or the largest, I should say, privately owned life science office company in the country. QTS Data Centers, which is a fast growing data center REIT we privatized in 21. We're in an environment today where public companies in many cases trade at discounts to the underlying value of their real estate. In moments like this, we think there's a real opportunity to transact, but it's also not just privatizations. It might be buying assets, it might be joint venturing assets, finding ways to create those win-wins.
Let's talk about interest rates for a moment here. I mean, meteor rise over the past 12 months. How is that impacting the commercial real estate market?
Yeah, look, real estate is obviously impacted by interest rates, and last year what we saw was that higher rates did have an impact on valuations. It resulted in higher cap rates, or said another way, lower valuation multiples for real estate. To a large extent, I think our portfolio was insulated because we happened to own assets that produced really high cash flow growth, which helped us offset that impact. But I also think that we have to be careful and not be too backward looking on interest rates, because if you think about what's happening today, the 10-year has actually declined from 4.2% at the end of last year to now the mid threes today. And if you think about real estate values, they're more tethered to long rates than to short rates. And so in many respects, what was the biggest headwind for real estate over the past 18 months now actually might be a neutral factor, maybe even a tailwind.
What are your views on office?
Look, office is very challenging at the moment, and it was challenging even before COVID. You know, we had seen some challenges in the asset class and intentionally underweighted the sector, taking it from what was 60% of our global business to today US office being less than 2%. And now you have compounding the challenges, remote work, and a pullback amongst some of the big tech users. Our view is that it's a time to be cautious on office. At the same time, what I would say is that where you invest matters, and there are subsectors within office that are still quite strong and resilient. And I'll just give you one example. We own lab office buildings in Cambridge, Massachusetts, next to MIT. These are buildings where biotech companies are doing really vital R&D work. And this is the kind of work that can't be done from home, can't be done from your kitchen. And so we still see really strong demand for that asset class. So we're in a world where you really need to dig one layer deeper, leverage data, leverage the insights that we happen to have to make really good decisions, and there are winners within this asset class.
Right, well, to your point, even before the pandemic, in 2019, everyone in this room, we work remotely anyway. We're traveling all over. I mean, that trend was there even before the pandemic.
Yeah, and there were other challenges in office as well. What we saw was that users were generally signing shorter term leases, and generally it required more capital to induce them to sign those leases, more free rent, more tenant allowance, more concessions. And so it was a sector that was challenging. Now again, big difference between commodity Class B assets and sort of the best assets, which today are performing quite well. But yeah, it's a sector that had its challenges, and as a result, we really pivoted our business to overweight the places where we saw stronger growth and secular tailwinds. We found over a long time period, it's much easier to produce performance if you have tailwinds behind you.
All right, Nadeem, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you, Jill.